You're listening to Only in Seattle.
Welcome to Only in Seattle, Summit Properties Northwest, podcast number 9. And I want to kind of go through super quick and introduce everybody, but I am Sean Reynolds, the owner of Summit Properties Northwest and Reynolds Kline Appraisal. And today in the house on producing this podcast, we've got Darian Dunstan. He is our social media manager. We have got Tristan. He is one of our videographers and editors. And we've got Nikki. He is also video guy and edit guy. And they're all working on this podcast so we can make it a great podcast for you listeners out there. And today I've got one of my oldest clients on the Reynolds Kline side, who is one of the principals and owner of one of the bigger private lenders here in the Pacific Northwest. His name is Mr. Brent Eley, and he is with Legacy Group Capital. And Brent, welcome to the podcast.
Thanks for having me, Sean.
Nice to have you on.
I don't know if that's good that I'm one of your oldest clients.
I know. We talk about
Right.
being old, and it's like, are these guys going to die?
Yeah.
Are they going to just keel over and die? But one of the things about being able to have your own podcast is you can kind of cherry pick the people that have the most experience. And because you and I have been doing this for a long time, we've got a lot of experience, and hopefully we've got interesting stuff to say.
Yeah. We've seen a lot of deals together for sure.
We've done a lot of deals over the years. Yeah, a lot of deals. So Brent is a private lender. He has guys in his office who bring money in on the investment side, and then Brent kind of manages the lending portfolio and works with private investors and builders and rehab guys to lend that money back out and get a good enough return that people keep investing with Legacy Group Capital.
Yeah.
Before we get into that, Brendan, I wanted to tell you a super quick story. It was the first time I met you, and I had heard of you through the grapevine, other people, through Steve Tedrow I was working with. And it was a Christmas party, and we think it was 96 or 97, somewhere in there. And you were with Bay Mortgage, who morphed into Legacy Group lending eventually. Mm-hmm. But first time I met you, you came up and we were talking about things, and I wanted to do business with you because I knew you did a lot of new construction. You kind of always had that background, and I've always enjoyed doing new construction. My family's got a couple of builders in it, and that's always been something I've been interested in as well. You came up to me, and at that point in time, it was my partner Seth and I. We own Reynolds Kline Appraisal, and we were basically only doing King and Snohomish County because that's just how it had always been done at Reynolds Kline Appraisal. So you came up to me, and like the third sentence out of your mouth was, "Do you do Pierce County?" And so, of course, what did I say?
To my partner's chagrin, do you do Pierce County?
Absolutely,
Yeah, right.
We do Pierce County. So I had to make a judgment call. Right then, we started up
that's funny.
doing appraisals in
Yeah.
Pierce County.
Yeah.
Pierce County had a different information system, and it was pretty expensive to get the data. So it was just something that we hadn't really gone after, and it was kind of far away, and it was kind of this mystical place. Oh, Pierce County, Tacoma's down there. Oh, I don't know. We're always if you're from the east side, if you're from Bellevue, you're familiar with King and you're familiar with Snohomish, but Pierce is a different animal. So,
no, I appreciate you actually making that decision because it's actually worked out well for both of us.
Yeah.
But, I started in the business for Puget Sound Bank, which was a big regional banker, and my office was in Federal Way. And so my business ties when I started were down south.
Right, and your wife's got some family down there.
Yeah, and so it was just kind of, and I learned that coming to the east side, people sometimes don't realize that there is business outside of, King County and Snohomish County, that there's other marketplaces.
You'll tell people name of a city, and they'll just have that glossed look on their face.
Right.
They'd be like, where?
Right, we're not London down there.
Yeah, I've heard of that, but sounds far.
Yeah.
Do I have to get in my car and drive like more than 20 minutes?
Yeah.
Because if I do, I'm out. I'm not doing it. So tell me a little bit about private lending and how you get into that. How did you get into that?
So my path into private lending was kind of what you had mentioned, is I always had enjoyed working with builders in new construction. And when I was building my business, trying to figure out, how could I best suit and be a part of the builder's progress and helping them grow their construction and be a piece of each part. How could I actually lend to them? And so one thing I learned is that being able to help the builder acquire the property and help the builder build the house was obviously important, and then I could get the takeout financing. For me, it was more enjoyable being.
Explain what takeout financing is.
So once the house was built, then obviously
Yep.
a buyer would come in and they would acquire the property and then
Yep.
be able to do the mortgage loan for the end buyer at that point in time.
And so to acquire it, most builders do a construction loan.
Right.
And then once the home is built, you
Then
can
they
get the
sell
takeout
it, and
loan.
we get the takeout business.
Yep, which is just a typical residential loan
Correct,
with normal criteria instead of the criteria you have on a construction loan.
Mm-hmm.
And you primarily at Legacy Group Lending or Capital, you guys do interim financing, which is acquiring the property short term and then maybe giving them some money to do the work they need, or acquiring vacant land and getting them a construction loan to construct a home if they're a builder.
Yeah. So that's primarily what we do now is if a builder wants to go ahead and be, and acquire the property and not go through the bank financing, they have to have another source to go ahead and do that. Or, besides paying cash, if they pay cash, then, they're using a lot of their funds. And so we'll go ahead and step in and do those different financing steps that they need to proceed through the project. And kind of growing up in the business, I enjoyed being a part of that process and doing as much business as I could with one person, as opposed to doing multiple business. And there's a lot of competition in the mortgage side of it, and so
Yep.
being able to be instrumental in each piece of that was kind of where I wanted to build my business off of. And there's always been a private lending business in Seattle for years and years, and
It's always just been kind of a small niche type.
Yeah.
Because
And
you were
people
one
have
of the
done well.
few guys doing it way back in the day.
Yeah.
We're all kind of like, we don't really know what Brent does,
Yeah.
but he gets people loans that everybody else can't,
Yeah.
and he should just go with that. And that's what you've done.
And that's what I've done.
Yeah.
And so, what I saw, I just thought that we could eventually how that business was being conducted and how builders were being, private lending has always been like kind of Guido's going to come out and break your ankles and if
Yeah.
you don't pay back and those types
Guido
of
the
things.
killer pimp.
Yeah.
Yeah.
And but being more of a partner with these guys and,
Yeah.
and making sure that you're there to help them out through through the whole process. And I always felt there was a better way to do it, and that we could kind of grow that business, because over the years that that we've been doing this, I've seen funds come and go, mismanaged for whatever the reason is, not treating the builder correctly, not treating their investors correctly, not writing loans correctly, whatever it is, but that there's a way that you can do it and be very professional with it. And that's kind of how my forte was into that segment of the business. And you're right, people always were like, I don't know what Brent does, but
Yeah.
eventually
That's
I know
because
he's going to
it's-
get a mortgage.
Yeah, it's a little bit out of the norm, but if you are in real estate, how many builders in the Pacific Northwest have hit you up? If they're anybody of note, they've probably been through your office.
Yeah, well, what I learned is, builders, they run their business just like anybody else runs their business, and they have needs, and they're going to go to banks. They're going to go to, and they may not go to a private lending company, but they may bring partners in. So they're always looking at ways that they can go ahead and acquire more property or do more business. So, and it doesn't really matter what their finances are. It's a way of how they can actually grow their business. And if it makes sense and you can be a good partner, then they're going to look to borrow or look to just be a part of your growth, because they want to go ahead and continue building in this marketplace. So it doesn't have the bad connotations like the big builders or successful builders don't use private money. Everybody
Right.
has different needs. They may need to close on a property because it's a great deal, and they may need to close quicker than what their bank can perform, and so they go out and they take advantage of it and go through a private lending need because we're more nimble. We don't have all of the hierarchy at a bank. Eventually, they may roll it into their line, or they may get other financing on it. But every builder or every investor in this marketplace, I wouldn't say everyone, but a lot of them have gone out and taken advantage of, whether it be a company like ourselves or whether it be just their buddies who have some money who want to go ahead and invest in a project.
Right. So let's talk about, so the lending that you guys do is, let's see, we've got construction loans, build new construction homes, whether that's for a single party that just needs construction financing. They're not looking to sell it at the other end. You've got rehab loans, an existing home somebody wants to put back together. We've got bridge loans. That's to gap the loan between when you are living in a house and need to sell it and buy the next home. We've done a video on that. If you want to look at our YouTube channel, and you'll see bridge loans are back with Shannon Kershaw. We've got mezzanine loans, and I'm a little fuzzy on that. That is a loan in the middle, correct?
Yeah. So, one thing that going back to capital needs for builders.
Yep.
And I think what a lot of builders learned in this last downturn was, maybe they don't want to go ahead and put all their capital into a project in case the market does turn, and then they need cash, and all of their money is tied up in a project, and they can't get it out. And so what we found is that builders would maybe want a little bit of help with that down payment. And for us, in our how we underwrite a deal, we require a certain amount of money into a transaction. On a spec loan, it's a minimum of 15%.
Spec loan.
Spec meaning a builder's going to go ahead and buy the property, build the house, and then sell it on the open market.
Speculative construction, going to try and make a profit.
Right.
Yep.
Hopefully we're making a profit.
Yeah, because if he doesn't, we're hosed.
Right.
Yeah.
And so even more so on our mezz loan, we underwrite that on a profit. We underwrite that based on the fact that we're going to maybe go in and pick up a tranche of that down payment. So what that does, that loan sits behind our first mortgage, our first loan, our first construction loan. And let's say that loan's $100,000 and our mezz loan piece is $15,000. We have a first and a second then on that property. Okay. And so we get a rate of return on our first, and then we get a rate of return on our second.
Is there a higher rate of return on the second?
A higher rate of return.
It's got more risk?
Yeah, it's got a little bit more risk. Yeah. And then for us, we participate in the profitability of that project as well. So we get a piece of the interest, and then we get a piece of the profit as well.
So that's when you would put in the mezzanine, mezz loan.
Yeah.
Okay, sounds good. And then you do residential mortgage loans and commercial real estate loans as well.
Right. Yeah.
Okay.
Yeah.
Tell me about, and we were just touching on that. Tell me about your capital requirements. Say a builder or a home flipper comes to you. What are your typical requirements for that person? What can they expect the terms to be to get a loan from Brent at Legacy Group Capital?
So our minimum down is 15%, whether it be a speculative construction loan or a flip loan. And this is all for sale products. So if a builder is going to come in and acquire that property and their end term is to go ahead and resell that, then our minimum down is 15%. And that 15% is based on your cost to acquire the property, your cost to build, and then any other financing costs you have on top of that. Yeah. So, and we always build in an interest reserve on that, and so payments are made out of the transaction. But part of our total cost analysis is based on all of those factors. Yeah.
How long can they get a loan for? What's the loan term?
So we're a short-term lender, and our minimum loan term is 3 months, and our maximum loan term is 12 months. We do have extension provisions in there to go ahead and extend as needed, but we don't like to initially go into any project underwriting it past 12 months.
Okay. What can people expect to pay points-wise and interest rate-wise? Give me a range.
Yeah. So on all of our for sale product or spec bridge loan or fix and flip type of transactions, we're a minimum of 2 points up to say 3.5 points depending on the duration, and we're 10 to 11% in this marketplace right now.
Okay. Yeah. Interest rate wise.
And then we're a little bit different than a lot of private lenders out there. And since we grew up in the mortgage business, we do consumer lending as well. And so we know that piece. And so There may be one or two, but I'm not familiar with them, that other consumer lenders out there or private lenders like ourselves who have their consumer lending license. And so we'll do a lot of owner-occupied custom construction loans where somebody's going to go ahead and acquire a piece of property, hire a builder to go ahead and build that, but they're going to go ahead and move into that property and keep it as their residence. So that financing is, somewhere in the 1.5% to 2.25% range, and somewhere around 7 to 7.5%, depending on size of the transaction and duration. And we have LTV requirements and credit score requirements to go into that as well.
And you analyze those. So let's get into that a little bit. So you've got two kind of moving pieces to your puzzle. Most importantly, you've got the property. You got to analyze that. Does the deal make sense? And number two, you got to analyze the borrower, who's either the flipper or the builder or the home builder. How do you go about checking out those people? What's your criteria? And how do you go about making the decision, yay or nay, on this deal?
Yeah. So, it's interesting because everybody you obviously want to have a good borrower, you obviously want to have good collateral and those types of things. Yep. But our main goal is our exit strategy. And so
an exit strategy
meaning how are we going to get out of this transaction?
How do you get your money out of it?
And so we reverse engineer everything we do. And if we get comfortable with how we're going to get out of it, then obviously everything else needs to come in line as far as the property, the location, the borrower, and those things. But we need to know, if it's someone that's going to keep the property and move into it, that we believe and that we know that there's financing available to the best of that the world lives at that 12 months down the road, that there's financing available that they can go ahead and qualify for. And so we'll go ahead and we'll stress that loan based on, loan to values and interest rates and those things, credit scores. So if the value comes in a little bit lower, if their income drops a little bit, if rates go up, that there's a couple ways that they can go ahead and get out of that as far as the financing goes.
And how do you know what the value is?
Well, we use this, I guess, since 1997, and we don't do much business in Tacoma as of late, but we use most of our stuff goes through Reynolds Kline Appraisal, and they've been a great partner of ours. And, I always have this conversation because we're a private lender, but we're levered with the bank as well. And so, your company gets probably 90% of the business that we do. And as a private lender, we can go ahead and pick and choose who we want. And I've had many conversations about, why do you give, most of your business to Reynolds and Kline? Because at the end of the day, I feel that they are a partner of ours and that they're not going to go ahead and lead us astray. They're going to give us the straight truth, good or bad, and that's more important to me than, price or speed or anything else that goes.
Not that our price or speed is bad.
Yeah, but I'm just saying, but it's, it's just, more of a partnership, and we value that as far as a company. Yeah. Because we all can make a mistake, and it's always better to have eyes, looking at it on different ways. And so, I always tell people I've never lost any money, as far as I've made a decision that I shouldn't have, but we haven't lost any money doing a deal that they've, valued for us. So,
and you guys have been a great client, and the reason we like working with you is because we are put in a position where we have to actually do our job and tell you what our opinion of value is, because you guys have your own money, whether it's your own money or your investors' money, on the line. And if these deals don't work out, I'm going to hear about it. Hey, Sean, you said this was worth XYZ. We've got it on the market. It is not selling. What's going on? Yeah. And you and I have had many conversations where you're like, on your end, you're like, I feel there's more value there, and I'll be, it might be, and I agree with you. However, what I can support on paper with an appraisal is XYZ. Here's where I'm at, Brent. Yeah. Beyond this number, it's kind of like, I agree with you. However, this is what I can support. And those are the numbers you need to make your decisions.
Yeah. They're good, candid conversations, for sure.
Yeah. Yeah. And that's a massive difference between dealing with somebody in private lending and dealing with most residential lenders on the appraisal end, because we have to go through management companies where we can't have any conversation at all. Right. Like none. Right. And so I've lost the ability as an appraiser to to be able to actually talk with people who know their stuff.
Yeah, yeah. And so that's why we we wouldn't use a management company as well, is because we want to have that relationship.
Right.
And we need to know that we're getting the straight scoop on our deals.
Right.
Yeah.
So tell me a little bit. So we've talked about how you guys do your lending. Where does your money come from? On your website, you've got the Legacy Opportunity Fund and the Northwest Fund. Do you have other funds out
No,
there?
we just have the two funds.
Okay.
So the Northwest Fund is actually the original fund that we started with when we started Legacy Group Capital back in 2008. The name is morphed, but the type of fund it is has been the same, and it's grown. And that's 100% lending fund. All we do out of that fund is lend on the type of loans that we've chatted about a little bit earlier, very short term in nature. And so we raise money through private individuals, accredited individuals who invest into the fund. And we pay them right now, we pay them a 9% rate of return on a 2-year note. So they basically are take a note from Legacy Group or from the Legacy Northwest Fund for 9%, and they get paid interest on a quarterly basis off of that note.
Okay.
Then those funds are levered with the bank, and we have a line of credit with the bank, and we use Columbia Bank, who participates the loan, and so those that line is senior to the notes. But between the money we raise and the capital from the bank is kind of our pool of funds that we have available to go ahead and lend off of.
And what percentage of your business gets the money from your fund? And then what percentage of your business do you need to take money from the line of credit to make it work? Obviously, it's a daily ongoing thing. It's up and down. What does that look like?
So since the money we bring in is more expensive than the bank line, then we always use the investor's money first. So we'll go ahead and use the investor money, and then anything above that will be levered with the bank.
Because that is less expensive
less
for
expensive,
you guys.
yeah. And so it's lower interest rate terms.
Right.
Yeah.
You mentioned accredited investor, and that's actually one of my questions for you. What does an accredited investor look like? And this is a guy or gal who's going to put money into your fund. What's accredited look like?
Yeah, so the SEC came out with private lenders that to be in order to go ahead and invest in a fund like us, that they want you to be accredited, and that means that you have a certain net worth, and that is essentially $1 million of net worth outside of your house. So if you have a house worth $1 million and that's all you have, then in the SEC's eyes you're not accredited. But you need to have liquidity outside of that to go ahead and meet that requirement. It also can be an income requirement, and it's different for singles and married couples. And then if you're a trust, there's accreditation requirements for a trust. And so we have a process that we go through and send them through an online attorney who goes through and they get accredited to invest in us.
To invest. And what happens if you take money from somebody who does not meet the SEC guidelines?
Well, we don't. Yeah.
Okay.
We just can't. We're not allowed.
If
to.
you did, then there would be a fine, and there would be some kind of
we haven't
disciplinary.
gone through that process. I don't know what it is. I know there's funds out there that you can have a portion of your fund go through, be non-accredited investors. That's just not how we're set up. So,
Right.
Yeah.
You guys are just straight up, here's where we're at.
Yeah. Yeah.
And with as much money as on the east side
Yeah.
in Bellevue.
It's interesting though, as in the last few years, we've actually really grown our investor portfolio across the country. We have a lot of people who invest in our fund. We've gone on a couple it's called Crowd Street. They're out of Oregon, and we are on there as an investment, and we've raised a lot of money from, New York, Florida, Texas, all over the place. People looking to go ahead and invest capital. People outside of and we I think at times we get it kind of just, well, this is where we live. This is Seattle, Bellevue
This is
area.
normal.
Yeah. But people love investing their money here, and I guess you can see it by all the cranes and all the construction activity and things like that. But
so much activity.
But a lot of places, they don't have this going on.
Right.
We've been living this for the last 10 years or so,
Yeah.
So this is just normal for us. But
Yeah.
people love investing, in this marketplace.
Well, that's because it's gone the right way for
Right,
us
yeah,
all
right,
for
yeah.
so long.
Yeah, yeah.
And us old guys are always kind of looking over our shoulder. And you and I have this talk probably at least a couple of times a year. And maybe now is a good time to get into it. What is the Seattle housing market doing?
Yeah. Before we do that, I just want to talk about the other fund real quick. So
Oh,
we don't lose sight
sorry
of
about that.
Yeah. So
we talked about the Northwest
Yeah.
Fund, and so now we need to get into the second fund, which is, what is it
it's
again?
the Legacy Opportunity
Yep.
Fund. Yeah.
Okay. Yeah.
And so that fund is a little bit different in the aspect that we can lend 100% out of that fund. And so the different lending criteria between the two funds are in the Northwest Fund, we do all of our owner-occupied financing in that fund. So we don't do any owner-occupied financing in the Legacy Opportunity Fund. So there is kind of a difference
Okay.
as far as the lending profile. So would be all speculative construction, fix and flip, bridge transactions, those types of things.
Truly just commercial stuff.
Truly commercial stuff.
Yeah, okay.
All for sale.
And that's the difference between the two funds.
Yeah.
And they're set up separately.
They're set up separately.
When was that fund put into
So
place?
that fund was started we took our first investment in, I think it was July 2015. And so
That's a fairly new fund.
Yeah,
then.
fairly new fund. And that's also where we do our mezz financing out of that fund. And so
Okay.
we do our mezz piece in that, which can be 25% of our assets under management, which means how much money we have in the fund. And then we also can do 25% into real estate transactions where we'll go out and we'll buy, a lot that we'll develop and permit and maybe sell it to a builder, or we'll go out and buy a lot that we'll build and sell. So it kind of juices juices kind of the profit of the fund as well. And so that can be 25% of the fund. So it's more real estate based as opposed to lending based, which the Northwest Fund is.
Okay.
Yeah.
So it's a little bit distinguished
Yeah.
from the other fund.
And that's a membership fund. So when you invest in it, you get an 8% pref, and then you get profitability as well.
So there's profit taking.
Yeah.
Okay. And how many investors do you have in that fund?
Oh, I mean, I don't know, 400 investors or something
So
like that.
it's quite a
big.
few.
Yeah.
And how about in the other fund?
I mean, it's not quite as big, but I mean, in the hundreds.
Okay.
Yeah, probably not 200, but
Couple hundred, 300
150
maybe,
or so.
something
Yeah.
you'd have to check.
Yeah.
It's not something you look at every day.
Right.
Oh my gosh,
Yeah.
we're down 3 borrowers.
Diana will know. She'll know what it is.
Yeah, we're down 3 investors. Okay. And so we're going to talk about our livelihoods are, a lot of that is based upon the market doing well. And you and I are still here after the crash of 2008. That was not a fun time.
No. Yeah.
But we got through it. Did you guys lose anything? Did you lose anything in the crash?
No, we didn't lose anything, and we also didn't lose any investor money. We paid, all of our investors their, and that was when we just had the Northwest Fund, and back then we were paying actually 10% to our investors, and so we paid them not only all their capital back, but they also received all of their interest that they were earned as well. So we are happy the way the fund performed through that downturn.
And by the fund performs, a lot of that has to do with the decisions that you, Brent Eley, makes on a daily basis. And you're known as somebody who takes good risks, will make the deal work if it's a make sense deal, but also isn't afraid to turn it down to not jeopardize the fund.
I mean, I appreciate them. I have a great team. I mean, the people in my team they've been with me and my partners for a long time. And so, I manage the day-to-day of the fund, but it takes all of us to kind of get through
It's
those
like
things.
me kind of sitting here taking complete credit for this podcast.
Right.
I could do that because I'm
We really know
I'm
who's
the
working
talking
around
head.
here, yeah, right.
Somebody listening to this might think that, Sean's just doing a great job doing all those jobs.
Yeah.
I don't know how to do any of them.
Right.
All I can do is sit here and talk.
Yeah.
Literally just talking head. So you guys do have a great team. You got some great people. Shannon, love working with her.
Yeah, she's awesome.
People that you can look at. And Scott's really good. Scott Rarucka is really good at bringing money into your funds.
Yeah, no, Scott's a great, he's knows a lot of people. He's very active out there, well connected in the community. And so it's been, I think all of us are able to kind of find their place and do it. And Scott's very beneficial as far as just being part of that capital raise. And he's also, is very instrumental in making decisions as far as how we underwrite and do transactions.
Right.
Yeah.
Yeah. Because he's got mortgage background as well.
Oh yeah. No. I mean, he's grown and built many mortgage companies. So
Right.
it's the way he grew up.
Right.
Yeah.
Yeah. And he just keeps doing it.
Yeah.
So what do you think about Seattle? Some people are thinking that it's cooling. Some people are thinking without all the foreign investor money that we're due for a downturn. But then other people that I'm kind of more in line with, they're looking at the jobs numbers coming in. And even just Facebook committed to another 5,000 or 6,000 jobs right here, 9 blocks down the road at the Spring District. I mean, there's just some monster companies already here, and they're bringing more jobs. And smaller companies are coming here because they want to poach the big companies' jobs.
Right. Yeah.
So what do you think?
Yeah, I'm a very half glass full type of thought process in all of this, and I actually feel right now that the market is, a lot of people have been calling for cooling and a recession, and I don't see it. We were just talking a little bit ago, and people ask me like, well, how are sales, and and across King County, and when I look at the marketplace, I really kind of base it on, how is our portfolio performing. And meaning, not how the construction's happening, but when these units come onto the market for sale, how quickly are they being absorbed and selling?
Right.
And in the last 90 days, we've probably seen some of the fastest absorption or selling of units than we've seen in the last maybe year and a half or so.
What are you attributing that to?
Well, obviously, it's jobs. Rates are down, so that's partly it. There's really good liquidity in the marketplace for mortgage financing, and that's going to drive our takeout.
And liquidity meaning there's a lot of money out there.
A lot of money, and there's a lot of banks coming in. There's a lot of hedge funds coming in to make sure that there's lending available. Companies looking for yield, and the mortgage market is performing really well, and it's not a lot of crazy lending. The lending going on for that mortgage business right now is money into the houses, really good ratios and analyzing of the borrowers, and so there's not really that, I think, that perception that there could be a bubble as far as that side of it goes. So I'm very optimistic about this marketplace. Obviously the job component is, one factor of it, but I guess rates are the other. But, if you kind of look at our geography as well, we have mountains on one side, we have water on the other, we have limited land. So we're always, even if we take a step back, I don't know that we can really go that far,
We've got a supply issue.
Yeah. It's not like, Arizona where you're building
going
on one corner and then you go across the next corner if it doesn't work out and it's just barren land.
Dallas, you just keep building. Just extend your road and your utilities out further, and we'll just keep doing this. We can't do that.
So we have, and we have, geopolitical type of, issues as far as being able to get through permitting processes and things like that play a part of just, our kind of our values.
Right.
But we have a long ways to go because, a normal market, you would be able to tell me better than this, but I always look at a normal market being maybe houses selling in 3 to 6 months, right?
4 to 6 months is considered normal nationwide.
And we haven't seen that for a long time, and we've been below 3, so we have to even get back to that pace before we can look at even a slowing market.
We're under 2 right now.
Yeah.
Almost across the board, we're under 2.
So I don't ever want to be too optimistic, but I think this has been in the last year, this is the best I felt about the marketplace.
Okay.
And then when you talk to people who are working for Amazon or Microsoft, and they're in these companies, and they're like, we are so busy and we are doing so much hiring here locally that they don't even see, that they talk to their corporate world, and they have internal economists, and they're saying we don't see anything that's going to go ahead and slow things down for the foreseeable future. So I mean, that makes me feel good.
So if something does happen, it's going to be on a worldwide scale. It'll be the markets get rocked by something, liquidity dries up. It's going to be a worldwide thing, and we'll still keep going here because we've got as good a fundamentals as anywhere. Other areas of the country are already slowing down housing-wise. Yeah. But we're pretty insulated here. Like our when the crash hit us, other markets had already been slow for 2 years. Other markets had started slowing, like Florida and Nevada started slowing in 2006. It didn't hit us until 2008.
Yeah, I think our economics have always been, even during recessions, that we've been kind of on the tail end, and we follow the rest of the country. But we're never in it as long as anybody else.
It's the last to hit us, and we always recover the fastest. Yeah. Because there's a lot of markets that have not recovered from the crash of 2008.
Mm-hmm. Yeah, and it's tough for us to actually realize that. But, there are housing markets where people maybe are still underwater on their valuations, where here we've seen incredible appreciation, not only from 2008, but even over the last couple of years. And it's very rare that we see a property under. I don't even know the last time we saw a property underwater. And then you kind of look at, I even think the foreclosure market in this, marketplace, which I don't really track, but, there's less product going on, in that market as well.
It's so few and far between. Yeah. Because everybody can get out, they can do something with their property because they've got enough equity.
Yeah, because they can sell at the very least.
Right. Yeah, and get out and be okay. My dad has an appraisal company down in Oklahoma City. They've had virtually no appreciation since the crash, and he does all HUD work. HUD repos. Yeah. He does them all day long because they haven't had enough appreciation to get homeowners out from being upside down. So if somebody needs to move or relocate, they're upside down. They're going to walk away.
Yeah, I mean, so we can complain about the traffic and we can complain about all the construction and being able to get around, but we should be thankful and grateful that we, are in a place that has been able to make it through with flying colors, and that we have, I think, a pretty bright horizon as well.
It's a really great place to do business because you've kind of got this thing at your back, which is this roaring economy that doesn't come around too often. I think San Francisco had it before we did. Vancouver, BC has had it before us. They have kind of similar dynamics. They're geographically constrained, and they've got tech backgrounds. Vancouver, BC's got more foreign investors. But we've got some really good things going on. And we haven't even touched on that Seattle's a pretty cool place to live. Yeah,
no, people love it. I mean, we grew up here, and so and there's a lot to do, and people are very happy to come here. There's a lot, obviously, the outdoors and the hiking and the biking and skiing and those types of things.
Raise kids. Yeah. Get a free public education that's pretty good.
Yeah, schooling's great. Yeah. Which we've definitely seen a driver of families coming in and buying around, really good educational areas.
Right, the neighborhoods that have the good public schools. Yep, that's pretty crazy. What is the best piece of advice someone has ever given you about being a private lender?
So I always go back to a friend of ours that you'll know, Steve Gorder. Yeah. And Steve and I, when we first got into the private lending business, we had a little business together. Scott and I, and we were kind of doing some private lending on our own. And he's like, Brent, I've never lost money on a deal I said no to. So, if you don't feel it, then
that's funny.
There's going to be another transaction out there. But
so learn to pass
and learn to say no, because when you push the envelope and you kind of reach for transactions, that's when you start to get into trouble.
And that's typically when you and I talk, is when there's a transaction where you've got an estimated value, we know what that estimated value is, and then we look at the numbers and we go, whoa, we're off here.
Yeah.
Probably need to give Brent a call, let him know we're so far off that this may not work. But then the borrower might have enough equity in the deal where everybody's like, okay, we can accept that lower value, and we can still make this work.
Yeah, I mean, you got to get at that point in time and analyze the risk. And if you believe in the project and you believe in the borrower, and the benefit of it is if the borrower believes in it and they bring more money, then that gives you more faith as far as doing the deal. Because if they're all in, then you kind of know that they're going to kind of work through thick and thin to make sure the transaction works out.
Right.
So those are all good conversations to have. Obviously, if the borrower is not willing to go ahead and step up anymore, then maybe it's not a transaction that you want to hang your hat on, or that when things are going to go sideways, that they're not going to be a good partner and try and work out of it.
Right.
And so, partly, when you underwrite transactions, you also want to underwrite that character side of it and say, okay, hey, if things go sideways, is this borrower, builder, whomever it might be, do you think they're going to be there with you to make sure that we can actually get through the transaction and get it, put to bed and sold, or whatever that takeout strategy is going to be.
Right. Right. Let's talk about something that we've had a lot of activity on our YouTube channel has been the bridge loan we did with Shannon. That was called Bridge Loans Are Back. Tell me a little bit about private lending and bridge loans. So bridge loans, for those who don't know, give us a tiny rundown on that.
So for us, we do two types of bridge loans that we call it. We do owner-occupied bridge loans, and we do investor bridge loans. And so, really a bridge loan is any type of loan that just obviously bridges a gap between the acquisition to the takeout financing. And so for us, our owner-occupied bridge loan is a transaction where in this marketplace, a lot of buyers don't want to go ahead and list their house until they have another house under contract that they can go or that they can go ahead and buy and move into, because once they sell, they may not have a place to go. They may, be in a competitive situation, try and find a place, and so they want to make sure that they've nailed down that second step. And so what we'll do is we will go ahead and do the financing on that acquisition house for them, knowing that they can do all the takeout financing and qualify for that. And so we'll do that purchase transaction, and then we'll take their house as additional collateral for the transaction. They can then move into their new house, list their existing house for sale, pay down our loan, and then they'll go ahead and refinance out into a long-term mortgage. A
typical 30-year or whatever.
And those transactions, we love those transactions. They live on our books typically in this marketplace 3 to 6 months.
Because things get sold pretty quickly.
Yeah,
and
they can go through really quickly and get it done. And so for them, they can take advantage of the buy and not have to be, without a place to live for a period of time, or displaced and those types of things.
And they're going to pay a little bit more in points, but to them it's a matter of convenience, being able to make the deal work when they wouldn't, or maybe they found the perfect house for them. They don't have their current home sold. They don't have a line of credit set up. You guys kind of help them.
So we're a private lender, so we're obviously not the bank. So we're there a little bit more money. So they will pay a little bit more for it, but to your point, the convenience side of it, they may get a great buy because we can close fast as well, so we can get that done in less than 30 days.
So the borrower kind of weighs the cost of what you guys cost against the opportunity they've got, and a lot of times they say, in a lot of the cost of you guys is that you guys can operate super quick. There's no loan committee. I mean, there is, but it's you and a couple other guys who can make a decision, this makes sense, and your deal is done literally days later.
Yeah, there's not a lot of levels to it, so it's very very flat, very streamlined.
Right.
So we can get through the process rather quickly, and if we need to meet early, we can meet and get something done.
And that's why a lot of people go to a private lender, because you guys can, hey, I need this deal done like a week from now, closed. We get so many requests for that kind of thing. Can you help us out? We're going to fund on this thing, kind of whether you do an appraisal or not. But they need the appraisal, or they need the verbal go-ahead from us. Yep, we can put together appraisal that can support this. which is us kind of going out on our comfort zone, because we're supposed to have, before we tell you a value, we're supposed to have within our file complete support for everything to put out a full appraisal. Sometimes that doesn't happen.
Well, we record all the conversations anyway, so we just go back and we say, you said it, we got the value.
Yeah. And so we pull comps and we make sure, hey, we've got what it takes to put the thing together. Sometimes you don't know, but most of the time, and I've noticed that as I work with you guys longer and longer, and I work with other private lenders, that the longer you are in business, the better your borrowers get, and the better the properties that you lend on get.
Yeah, I mean, to your point, I mean, people, obviously, if they can close quickly, they want to take advantage of that and get a good buy. But the longer you're in business, you obviously have proven that you can do that. And so that, as they say, the proof is always in the pudding. And so as we've been around and established our name, do what we say we're going to do, then we get better and better, clientele. And and that goes back to our custom construction program for when we may have kind of cut our teeth in the private lending, but we'll get a lot of people who can go out and get bank financing, but they just don't want to go through the hassle. They don't want to go through the time that it takes to get through that underwriting side of it.
Right.
And so they know that they can go out and get financing at the end of the day for us, and they can take advantage of getting the project done and built, and that we'll perform. And so we've been able to really, I think, move into that marketplace and get great customers. And I have conversations with these guys, like, you can go get a bank financing for this. I'm like, oh, I know, Brent, but I just don't want to take the time or the headache or the brain damage to go through it.
Yeah. They come to you because they know you're going to get it done, and you've got a pretty good sized portfolio of builders who work with you and work with other lenders similar to you, because they're not going to put all their eggs in one basket. Yeah. They're not going to put them, and you would recommend they don't.
Yeah, I don't think anybody should ever have just one source, for sure.
Right. Yeah. Yep. And so on the appraisal side, we will have builders go from one private lender to the next to the next. And that's when it's either there's something going on with the property, or something going on with the borrower, or somebody's desperate or something. But the private lenders in the Puget Sound market, there's so few of them that everybody kind of knows everybody's business.
And I think for us, that's one thing that we, with our builder side of it, that we're very happy with. We have a really good stable builders that we do a lot of repeat business with. So it's very rare that we'll come across somebody new or that hasn't been referred to us, or that we know.
Who you're working with. Yeah. And they have a proven track record.
So and we like that. We like to have that relationship. Just like we like to have partners like you, we like to have the builder, whomever, be a partner with us as well.
Right, because you guys deal with some of the biggest builders out there.
Yeah.
On the residential side.
Yeah.
So what kind of marketing do you guys do? How do you get your business in? Is it basically word of mouth?
Yeah, I'd love to say we do a bunch of marketing, but that's not something we've done yet.
Yeah.
So our background is everybody in the company kind of grew up in the lending business.
Right.
Before, Legacy Group Capital was actually a sister company to Legacy Group Lending, which was started back in 2007. Scott Recca and some of the other partners in the company were a part of, and Legacy Group Capital was built in that, as I said, as a sister company, so mortgage lenders could go out and have another, kind of tool bag to go out and sell to their agents, as far as, whether or not they did a bridge loan or a custom construction loan. It gave them an opportunity to kind of get into the door and have a different story.
Gives them more options. Gives their clients more options.
Yeah. And so, there's probably 300 loan officers within that organization. So we, and not only that, but just all the other people that we know out there in the mortgage business as well. So we all produce and bring in business, but as well, we get a lot of referral business from people in the market who know of us and know that we perform, and have known that it's been a good experience for their clients. And so we even get calls from other private lenders, because they can't do consumer transactions. So we'll get calls from them as well to go ahead and they refer us transactions.
So your biggest source of business would be referral.
Yeah.
Yep.
Yeah.
Isn't it interesting as you're in business longer and longer, that's where almost all your business come from.
Yeah. And that's the way you want it to be, right? I mean, you want to know where your clients are coming from. And one of the things for lending, knowing your client, knowing where they've come from, and knowing that you've got to underwrite that side of it, because we're spending our money on every single transaction. So we really want to, that's another piece that we look at in great detail.
Because your business is literally on the line. If a transaction fails, you've got to report to your investors, hey, that money you guys put in to the fund that we funded this deal with, that deal went sideways. We're going to have to talk about this.
Yeah, no, we've got it. We report, we report our financials on a monthly basis. We get audited, and as well, we have bank financing in the fund as well, and the bank is looking at us. And so, for us, the bank would rather us work through a transaction and get out of it, as opposed to take a transaction back and have it sit on our books. And so we have a lot of eyes looking at our portfolio and seeing how we're performing from many different areas. And so it's very important how
you guys are regulated by the SEC?
Well, the fund is, but we're regulated by the DFI. We have our consumer lending license, and so we get audited.
Department of Financial Institutions.
Yeah.
Yep. Okay. So you've got a couple of different set of eyes looking at you from various.
You said, and that's not even the investors coming in and ask us how the portfolio is performing.
What's going on?
Yeah, I mean that's just.
How often does that happen?
Investors are always asking us because they want to know. And before they put more money in, they'll want to ask if there's anything that they should be worried about, or it's an investment, and so it's not like we're traded on the stock exchange, and so they can see the ticker tape. It's private, and so they. Obviously have every right to know, and we try to be as transparent as possible to let them know how things are going. But
do you have a max that you can let somebody invest with one of your funds?
No, we have a minimum. Our minimum investment's $50,000.
Okay, for both funds?
Right.
Okay. Yeah. And so if somebody wanted to put $50 million in, what would you do?
Well, 50 would be nice, but it would probably be a little bit for us to take down at this point in time.
Yeah.
But, no, people can put in, a couple $1,000,000 or whatever it might be.
Because I remember Rucka telling the story. He was talking with Bill Gates, and the story went something like where Bill asked him how much, could he invest in the fund, and Scott said something like 2 or 3 million would be fine, and Gates, this was quite a few years ago, Gates said something, well, like my minimum investment is 45 million. Something like that.
Yeah, probably Scott's 3 times the size that we were at that point in time. Yeah.
Should have just gone for broke and said, well, our minimum investment's 100.
Yeah. No, but we definitely watch that because, we want to make sure that we're bringing money in appropriately and deploying money appropriately.
Right.
And what you never want to do is have, and in the private lending world, it's difficult because you typically have either more money than deals or more deals than money. In our situation, we've always been blessed that we have more deals than money, so we can continue to raise capital and bring it in. But you want to make sure that you have, you're in a position that you can do that, because you don't want to be reaching for transactions and having to go ahead and do deals that may not make sense or be what, your lending what your lending guidelines, say you should do. So.
And that's what we're seeing happen with some of the younger companies, the more aggressive companies coming into the Seattle marketplace. And you and I have talked about how private lending is getting more competition, more young guys, and they will take those flyer deals because they need to get their business going, and they're willing to take stuff. They need to be more aggressive, whereas you have basically an adult career that's been built around solid lending. You don't have to necessarily take those deals, but everybody starts somewhere.
Yeah, no, you got to start. And I would say to anybody coming in the market is, I like programs. I like to say, well, this is what we're going to do, as opposed to looking at every single transaction. When people know what you're going to do, then you're your ability to get transactions is better because it's just not a conversation about some random deal in some random area. They know this is what you lend on, and so it's a real conversation. So I like to be very programmatic about what we lend on. But then you should put policies and procedures together, and you should go ahead and lend the way your docs say you should lend, and don't ever push, outside of that. But the one thing that I would always say that's done us well is make sure you understand your takeout strategy and that you're comfortable with your takeout strategy.
How are you going to get out of it?
Because I remember, when we were kind of in the downturn, we would get calls from banks to do some custom construction lending and great deals, but we would pass on them because we just knew there was no jumbo financing for a takeout loan and nothing on the horizon that showed that we were going to have jumbo financing.
So you could help somebody get it up and built, but then you're stuck with lending on that until they can either sell it or figure out some financing that at the moment doesn't exist.
So that's it's a very important, whether it be for sale, so you know that the market will absorb it, or whether it be a mortgage or another commercial bank taking you out, but understand what that risk looks like and that you're comfortable with it.
Yep. What is the most memorable home that you have financed? Either a memorable home or home that maybe a celebrity had or something along those lines, or the biggest house, or what comes to mind?
Well, we didn't finance it, but the biggest property would be that we looked at doing was it's the Rantham Estate.
Yeah, Ramtha.
The Ramtha Estate.
Down in Yelm.
So we looked at that years ago when down in the downturn, and we actually didn't help out with it. But that would probably be on a scale.
Let's talk about Ramtha for a second, because I think Darian, Tristan, and Nikki, we have talked about Ramtha, right? That was, come on now. Darian, have I talked to you about Ramtha?
I don't think so.
There was a 10,000-year-old spirit that was being channeled by a woman in Yelm, Washington, and it became a massive nationwide, I don't know, would you call it a cult?
Yeah, I think so, yeah.
And they had a compound in Yelm that was enormous.
I don't know how many acres and buildings. I mean, there was just tons of property there. Yeah.
And Yelm is probably, an hour and a half southwest of like Bellevue and Seattle.
Yeah.
Out in the middle of nowhere.
But then, I mean, really cool property, but who was going to come in and buy that thing and take us out, right?
Not great liquidity.
And a lot of the capital go ahead and put in one spot in Yelm. So,
right. Yeah. How much was the loan? Do you have any idea?
I mean, now looking back at it, probably, gets just because values are so high. But back then, 10 years ago, it was probably $4 million, something like that. So,
okay.
Yeah.
But
I mean, in relative terms today, people, that may not be a lot. But back then, obviously prices have really spiked in the last 5 years.
Right. $4 million now is entry-level new construction in West Bellevue.
Right.
Honestly.
Yeah.
It's crazy how that is. Any other celebrities or anybody?
I don't know that we've ever done any other celebrities. I would say, not the high-end stuff, but one of the things what I love about what we do is I think that it's helping buyers as far as opportunity goes, and I think the one impact that we have the most help with is somebody who may say, hey, I can't get into a house because I don't have the money for the down payment or whatever it might be, and we do a lot of owner-occupied rehab transactions where somebody can go in, acquire that property with minimal down and get takeout financing, and then the ability to go ahead and get into this housing market with some equity. And so we can go ahead and create the acquisition, we can create the value for them to go ahead and buy and build, and so they have a long-term place to live. Those are products that I think give us the most joy, is just being able to make sure that people can achieve home ownership in a marketplace that's getting to be more and more difficult to do.
So as a private lender, you are helping them achieve the American dream.
Yeah.
Yep. That's pretty good. Yeah, because usually you think of private lenders as guys who are going to break your leg if you don't pay them back.
Yeah, we'll break their legs too.
All right, so we are getting towards the end of the podcast here, so I'm going to go through a handful of questions unrelated to lending. So, Brent, if you had a choice between two superpowers, either being invisible or flying. Which would you choose?
Oh, definitely flying.
Flying.
Sitting in traffic drives me crazy.
What is so interesting is Forbes threw this question out to a few hundred well-known business leaders. 72% of them chose flying as their
Really?
Superpower.
Yeah.
It was just heavily weighted towards
Yeah,
flying.
that's surprising.
Because you think of being invisible, what am I going to really do with that?
Yeah.
Where am I going to go? Somewhere I shouldn't.
Right. Probably places you're not supposed to be.
Yeah, because you're not supposed to be.
Right.
I mean, really, where would you go?
Yeah.
So flying is pretty
Flying,
good.
and you could use every single day.
Right.
Yeah.
Yeah, you could. Yeah. All right. One of the standard questions I ask everybody is Coke or Pepsi?
Yeah, I'm not a big pop guy, but
Okay.
I would take Coke over Pepsi if they were both in front of me.
Diet Coke or regular Coke?
Diet Coke for sure.
Diet Cherry Coke or regular Diet Coke?
No, regular Diet Coke.
Just give me that aspartame
Yeah.
or whatever it is.
Yeah.
Aspartame. Yeah, give me the fake sugar.
Give me.
'Cause it
If I'm
tastes
going to
so
go
good.
down, give me the worst stuff that there is.
The stuff that everybody claims
Yeah.
you can clean
Right.
like boats with.
Right.
Because it's so toxic.
Yeah.
Okay. So if people want to get a hold of you, what is the easiest way for somebody? Like, what's the typical procedure? Somebody has a house, they want to get a bridge loan, builder wants to get a hold of you. What's the best way to get a hold of
Yeah,
Brent
I
Eley?
used to always tell them to call Shannon, but
Don't call me.
Yeah.
Call my coworker.
but if they can email me. The best way to get a
Yep.
hold of me is Brent Brente at legacyg.com, and hopefully we can have some conversations with some people on how we can help them out.
Okay. Yep. And I think your contact info is also on the Legacy website
yeah.
as well.
Legacyg.com.
Yep. So people can get a hold of you there. So if you are in the market for any kind of loan that falls outside of typical banking, or you need a quick loan, or you're a builder and you're looking to hit up another lender, Brent Eley is somebody that I would highly recommend, even just having the phone call with. So I recommend a lot of my brokers who are looking for anything outside of the box, hey, give Brent a call, give Shannon a call, and you guys will walk them through kind of what they're looking at a minimum. You may not do the loan, but you guys are really good at kind of disseminating information pretty quickly.
We're always happy to analyze the deal.
Yeah.
I mean, and if we can help out, great. If we can give them some education as to why they should do it or why they shouldn't do it.
Yep.
It's free advice. So,
Yeah. And you guys have been really good at getting that information out there to people. So when I send Summit brokers over or Summit clients over, I know, okay, they're going to go talk to Brent. He's going to tell them the real deal. And so that's what people come to you for. So I'm thankful for our relationship over the years because we've been doing business for a long time.
Yeah.
Not a lot of guys left. They've gotten out of the business for one reason or another. And so as we get more mature, I'm not going to say older because we're more mature.
You think that's going to happen?
Yeah. That's not really our style.
Right. That ship has sailed.
Yeah. It's nice to work with people that we have worked with a long time.
Likewise.
And you're one of those people.
Yeah, we appreciate it as well.
So Brent Eley from Legacy Group Lending, thank you so much for being on Only in Seattle podcast number 9. That's it. Listeners, thank you so much for tuning in, and viewers on YouTube, thanks for watching this podcast. We will catch you on the next one. All right. Thanks everybody. Bye-bye. Don't forget to subscribe to our channel and hit the notification bell so you'll know when our next video is out.